Okay. Hi, everybody. I've got a couple ways I can go here. I've got some slides prepared that just kind of go through who I am and what our businesses are and what's been going on with the pandemic in terms of effects on the market and effects on our businesses. We can go that route, kind of like a presentation route, or we can just kind of go an interactive route first. So we could do presentation and Q&A after, or if you just have questions you're already set up with, like, hey, I just want to, let's have a conversation. I'm open to that too. So I don't know if you want to do the instant poll or if just maybe the people that are bold enough just want to pick a direction and we can do that. No one? No one has a preference?
Can you repeat the options? I'm so sorry.
No, that's okay. I can either go through my presentation. So I have a PowerPoint presentation that talks about our businesses, the markets, the effect of the pandemic on the markets and our own businesses, et cetera, et cetera. Maybe take about 20 to 25 minutes. And then we could do a Q&A after, or we could just start right off interactive, just going Q&A kind of the whole time. And I can bring in slides if any questions are relevant.
I kind of am leaning towards the presentation just to see where everything's at, like on a larger scale.
Okay, good. So is it Olya? Is that how I say your name?
Yes, you actually said it right. Thank you.
Okay, all right. Thank you, Olya, for speaking. I taught at Cal Poly, so I know how quiet you guys get. Don't do that to me. All right.
I try and be the talker just to kind of get everybody else going.
Good, I know, exactly. All right, I'm a Cal Poly alum, so don't be shy. All right, so here's the presentation. Can you guys all see that?
No, not yet.
Okay. All right, let's see. Okay. Now?
Yes.
Okay. Okay, so I should move this over. Hold on. I'll just go this way because it's moving to my other screen. So for my professional background, I'll start up here. So we're a commercial real estate appraisal firm. My wife and I own a commercial real estate appraisal firm. The blue areas there you see that's kind of our area of service. So Inland Empire, Orange County, LA, Ventura County, and San Diego. We have 18 appraisers. Our clients broadly are lenders. There are some attorneys and some cities. We're doing a project with City of Azusa right now, City of Culver City we've worked with, but mostly bank transactions, some litigation, some city work. We appraise what in commercial we would kind of call your vanilla product types. So retail, shopping centers, office buildings, medical office buildings, warehouse buildings, distribution centers, apartment properties, and then some special use, churches, schools, daycares, things like that. And we founded that company in 2005. Here's a few of our clients on the right side of the slide. So in addition to that, our family has invested and developed some commercial real estate projects. So our portfolio is in these cities that you see here. We kind of target the 210 corridor generally between like Fontana and San Dimas, but then there are a couple of projects where we go down the 15 corridor. So we just signed on to start another project in Eastvale. We have one in Hoopa Valley. We have one in Redlands. So generally we're kind of looking for medium and high income markets or high growth markets in the Western Inland Empire. I guess Redlands is not Western Inland Empire, but it's kind of unique out that way. We've completed 4 development projects, all retail. We have 2 development projects that are in the pipeline that we're about to start, 1 industrial and 1 single family residential. And it's just a small team, just myself, my wife, her parents, and Tiana. So 5 of us that work on those projects. And as a rule, real estate development firms are really small in terms of full-time employees because development the spout can like turn on and turn off so quickly that in a project, you're primarily using contract work, engineers, architects, attorneys, general contractors, consultants, all those people are kind of on contracts that are, for accounting purposes, connected to a given project. And then after that project's done, you know, you're not sitting there with a bunch of people on payroll that you don't know what to do with. So it's usually a pretty small team as far as the core team. So that's kind of our second part of the second tentacle of our business. And the third thing is that we are franchisees for a national preschool chain called Kitty Academy. And we have locations in Pasadena, Fontana, and Rancho Cucamonga. So these are, at least in the case of Pasadena, Rancho Cucamonga, properties we own, and in Fontana, we're a tenant, but also businesses we own and operate. So these are pictures of some of our kids. We've got extracurricular classes, so enrichment classes. So on the right, you'll see that's from our cooking class. In the middle, you see our kids, like they design their own masks. And then that sweet little girl on the bottom is just too cute not to have in a picture. So we started that in 2018. And the fourth, I mentioned there's another project we're looking to do in Eastvale. Eastvale or Ontario Ranch will be our fourth preschool once we find a site and get it going. So that's about us. I'll stop right there and then just pause for any questions that you have about background or anything I might have skipped over.
Can I ask, what do you guys do specifically?
What do we do specifically? Like with respect to which kind of part of our business?
More so within, so you work with the schools, but what do you guys do with them?
Okay, so we own the schools. So as far as Kitty Academy, we own, just like a franchisee might own a McDonald's or a Taco Bell, right? We own a Kitty Academy. We own 3 of them. So we hire the directors and the assistant directors and the teachers. We're responsible for marketing and accounting and, you know, really everything. It's just like your own business, like any small business. But in this case, it's a franchise. So we have that relationship with corporate in this particular industry that we find really useful because there are a lot of changes, governmental regulation changes in early education. There are a lot of oversight functions that the state of California provides. And so having a corporate partner really helps us to be out in front of those. Even just how to operate and market and communicate with parents and all of those things, that relationship is helpful. So we're running the business, but corporate is taking royalties and providing some functions that all franchisees would benefit from. So hopefully that answers your questions. Any other questions on our background? Okay. And then in terms of educational background, I went to Cal Poly Pomona, graduated FRL 2004. I'm not as young as that would suggest. I graduated high school in '94, kind of like wandered around in my life path for a while. Graduated 2004 from Cal Poly and then got a master's degree in real estate development from USC in 2010. But I've been in business since 2005. And I've been in real estate since I was already in college, like around 2001. Okay, so now I'll turn to showing you kind of what the COVID pandemic did to our business. So the orange is kind of like our revenues going back to October of 2018, monthly revenues. And you can see how they were trending. The blue is, the first blue is April 2020. And that's basically, the blue part is, I put April 2019 behind it in blue. And you can see that that's the part we didn't get. Essentially, that's our loss. If 2020 would have been just the same as 2019, all that blue area would have come in as revenue, and it didn't. So what that meant is that the COVID pandemic took about 20% of our 2019 annual revenue away from 2020. And it did it in a period of 6 months. So 20% annual, you could say, well, for those 6 months, it took 40% of revenue. So it was significant. But at the same time, the Paycheck Protection Program loan backfilled about half of that loss. And then the other half was either backfilled with temporary furloughs, cuts to some operating expenses, or just us taking less, from the business. So pretty much now the appraisal business is back to 2019 strength. It's actually pretty strong right now. So I think, at least for our part, the worst looks like it's behind us. I'm going to show you a little bit of, this is employment by sector. This is California information. One of the things that I like about Cal Poly, and I like about talking to you guys is when we get on our socials, or you're talking with family and friends, like, conversations are just so like, they're so extreme, right? The statements that people make about the markets or financial matters, it's like, oh, this guy is terrible, and this guy is great, and this company is going places, and this company sucks. And like, when you develop an expertise in something by way of education or by way of career, you start to learn that really all the wisdom is a lot more moderate, right? It's in the little differences between, like, hey, this company is set to grow for the next 18 months, or hey, this company's last product, failed trials, and so they're going to have a tough time for a little bit, have to raise more capital, right? The questions that with answers that actually make money, they're more boring questions. At least they're questions that you won't find on your socials. But when you're in industry, those are the kinds of questions that you answer to see what's really going on. So I try to get away from talking extremes, and I really try to talk data. And I would encourage you in that too, as you kind of go out on your job search, and you're reading about your industry, like, and your field of study. Really, like, get into the granular questions, because that's where the valuable information is. So on the employment change in California, you can see that leisure and hospitality, which is the second line here, that one lost the most. It lost 30% of its jobs, right? So, and then you kind of go down and you say, well, who else lost a lot? Okay, other services. I think there's another, like, yeah, those are the big ones. Look at some of the ones that just, it's not a big story. Finance and insurance is up 1.3%. Real estate is down 4.3%. So it's really certain industries that got hit really hard with this pandemic, and others that are already seeing some recovery. Next slide. This is a little blurry, sorry about that, but this is the employment by region. So you can see California, overall, the unemployment rate went up to 13.3%, and we've lost 9.4% of our jobs. But look at some of the others where you can see that Inland Empire was affected less and Orange County was affected more. So these regional differences are playing out right now, especially when it comes to the residential market. We're seeing people leaving the urban areas and going into the suburbs, and there's conversations about how permanent that change is. I happen to think it's more permanent. I'm kind of in the more permanent group, and I have some reasons for that we can go into a little bit later. Okay, 1 second, I'm just going to close the door. I'll be right back. Okay, back. This is NAREIT data for basically, I have the different property sectors on the equity REIT index mapped from January of 2018 going forward. You can see that the property sectors have performed differently as well. So I'll start with office, which is the blue. So office kind of hums along here until February of 2020. And then you see a drop from February to March of 2020, right when the pandemic hits. Office drops 21%. And then as we kind of go along, it's recovered a little bit, but not a lot. So right now, relative to February 2020, it's still down 19%. So it bounced back a touch. Next one, industrial, which is in the orange. You can see that when March 2020 hits, it doesn't fall as much. It only falls initially 6%, right? And then now look where we are. We're up 17%. from pre-pandemic. So industrial has performed really quite well. Like there's just no story about, oh, industrial is suffering. That's not an accurate story, at least according to the REIT index. Next is retail, which is kind of the grayish. You can see retail drops the most. It drops 43%, I think for obvious reasons, right? Those stores, a lot of them were shut down. And retail includes a lot of services too, your hair salons, your dentists, your barbershops. And then you see retail bounce back about 10 or 11%. So now we're still net down 32% from pre-pandemic. And then multifamily dropped, multifamily is the yellow, dropped 23% and bounced back a little bit. So it's still net down 21%. In terms of time, the office REIT values have dropped back to what values were in 2013. Retail is back to 2009. And that's significant because 2009 was a bloodbath. It was terrible, right? So that you can buy retail assets today, at least through REITs, at their 2009 levels, I would say there's some opportunity there, although you have to be careful about what you're buying, right? Multifamily went back to 2015 levels. Multifamily has been on a growth surge for years. So going back to 2015 levels is a fairly minor hit. And then industrial just only went back to June 2019 levels and now is already well beyond that. So again, the pandemic has affected geographies differently and it's affected sectors differently. And that carries over to real estate where we see that some sectors are still quite strong and others are really struggling. Overall though, when we're talking about kind of a 20, let's just say on average a 20% drop in the REIT market, the REIT market is much more efficient at pricing than the underlying real estate markets are, right? If I wake up tomorrow and say, hey, I want to buy REIT shares, I can. And if I wake up tomorrow and say, hey, I want to sell REIT shares, I can. If I wake up tomorrow and say, hey, I want to buy a shopping center, that's a 3 or 4 month process and there's a lot of transactional costs in it. It also requires that I find a seller who's willing to sell at the price I'm willing to buy at. So there's that meeting of the minds that has to happen. Whereas in the REIT market or on the stock market, that thing kind of happens automatically. It's very efficient. And the real estate market is very inefficient. So what the REIT markets tell us is, where did minds have to meet on that day to make a trade? And in general, I would say the REIT markets tend to overreact or exaggerate what happens in the actual real estate markets. Because in the actual real estate markets, if a seller isn't hurting, they're not going to sell at a loss. And a buyer is going to come along and say, wow, this is a pandemic. I want to buy at a discount. And I'm only willing to buy at a 20% discount. And the seller's just going to laugh, right? Because as long as you got your mortgage covered and you're rich, and most commercial real estate owners are, you don't have to do that. So understand that the underlying real estate markets don't move as quickly or in as much of an exaggerated way as the REIT markets. And I've got some scenarios to kind of show that. So I'll start here. This is like a really basic investment scenario, and I'm going to go through a couple of them so you can understand like what the effect of the pandemic would have to look like in order to get to the kinds of changes we saw in the REIT markets. So here's like a pre-COVID scenario. This is an investment that has $100 in net operating income per year, and net operating income grows 1.8% per year for 10 years. And at the end, you sell the property at an exit cap rate of 6%. So NOI divided by 6% equals your sale price. That's here, the 2028. And then this last line is your cash flow stream. At a 7% discount rate, that tells you this investment is worth $1,800. So what that means is the going in cap rate, which would be the year one NOI divided by the $1,800 NPV, is 5.7%. That's about an accurate cap rate for today for a lot of commercial products, high fives, low sixes. We already talked about 1.8% rent growth for 10 years, 6% exit cap rate, and we're using 7% discount rate. You know when your discount rate is larger than your cap rate that you're expecting what? What does a discount rate higher than the cap rate mean, just generally speaking? I'll wait. I know you guys learn because I know what's taught there at Cal Poly. So the denominator of the perpetuity model is a K minus G, right? So if K is the discount rate and K minus G is the cap rate, then what does it tell you that G has to be? If the discount rate is bigger than the cap rate, G has to be positive. When you subtract G from K, you get a lower number if G is positive. So what a discount rate higher than a cap rate means is that the markets are still expecting growth. And they are. They are still expecting growth over the long term. Discount rates for the last 3, 4, 5 years have been about 150 basis points to maybe 175 basis points higher than cap rates. Now today, they're about 100% or 100 basis points higher than cap rates. So there are still growth expectations, but those growth expectations have been tamped down a little bit. Next slide is the V recovery. So you've seen headlines about, is it a V recovery, a U recovery? This is the V recovery kind of presupposition. So let's assume that for the next 2 years, our cash flow from the same investment dropped by 50%. And then in year 3, it picked right back up and it was right back to where it was, 1.8% rent growth and all that. If we use the same going out cap rate, 6% at the end, and the same discount rate, our value now is 94.8% of the pre-COVID scenario. So your value went down about 5%, and you were only able to collect half your rents for 2 years. That's, if you talk to somebody about, hey, what if you're only able to collect half your rent for 2 years, and you put that in a USA Today article, that would be like, oh my gosh, it's total destruction. If you look at it in a financial model, you go, okay, well, depending on how you're leveraged, that's actually not a lot of value destruction. It's a short-term interruption, right? So that's the scenario that would be the V recovery. Like, hey, this was just a temporary thing. Nothing's really going to change permanently. Once we get a vaccine and once we get back on our feet, this is where it's going to be. In that case, I would expect that what the REIT markets are showing is an exaggeration of what's really going to happen as things kind of recover and balance out. Next one, the U recovery, which is probably where most economists are. They're saying like, yeah, there's going to be a recovery, but there's going to be kind of a flattening out on the bottom for a little while before we come back. So I'm calling this one, let's do the same thing with the first 2 years. Let's drop our cash flow by half. And then after that, let's have kind of a soft return. So instead of returning in year 3 to where we would have been in a pre-COVID scenario, which is 105.50 in net operating income in year 3, we're going to return to where we were at the beginning. So we're 101.80, and then we're kind of coming back slowly. In that scenario, your NPV is 91.6% of your pre-COVID NPV. So now you've lost 8 or 9% of your value. Again, not a happy time, but unless you're over leveraged, this doesn't mean that like, oh, your commercial real estate went to hell in a handbasket, right? 10% of your value, if you are leveraged at 60% debt, that 10% comes out of your equity piece, of course. So 10% of your value is more than 10% of your investment, of your equity investment. It's, 20, it could be 30, it could be 40, but it's not that you went to zero, right? And that's kind of what's different about real estate as a tangible investment and a REIT stock, is that you actually have something when you have an investment, a piece of investment real estate, that it's not going to disappear from the face of the earth. You're going to go through some bad years and you're going to go through some good years. And it really depends on your capital structure and your operating expertise and, how you're managing your cash flows. Next one. This is, the pessimists are talking about the swoosh recovery, like the Nike swoosh. So it drops down hard and it comes back like really, really slow. So what I did here is, you can only collect 50% of your cash flows for 2 years. And now instead of rent growth in the following years being 1.8% per year, it's 0.9% per year. So our whole rent growth structure has kind of changed. Amazon's going to take over everything. Rents aren't going to grow like they used to, et cetera, et cetera. If we do that, then we're down to 86% of pre-COVID NPV. So we've lost about 14% of value. We're starting to get into the significant areas now, because remember the NAREIT index was showing us losses of around 20%. So now our property model is starting to show us something kind of similar to what the REIT markets are telling us. But I don't think a lot of people on the ground on the real estate markets believe that it's going to be this bad. Maybe we're wrong. That's always a possibility. But this would be getting on to kind of Great Recession levels. And I don't think that this situation for real estate assets is as bad as that situation was, having lived through it. Finally, I call this the WTF recovery, which is like, this is just a total, like nobody is really expecting this. This would just be really bad. So let's assume now you got half your cash flow for the next 2 years, your rent growth slows, your cap rates rise 50 basis points and your discount rates rise 50 basis points. So essentially when discount and cap rates rise, what we're saying is the overall expectations on a permanent basis for real estate investments are that they're more risky now than we had evaluated in the past. Now, you have to, when you say something's more risky, you have to ask that question 2 ways. You can ask the question, is it more risky than before? To which maybe a lot of people would answer yes. But you also have to ask the question, is it more risky than before relative to its alternatives, right? Opportunity cost question. That's really the question that gets asked, because the money still has to be allocated to some type of investment. So is it more risky as an asset class than the stock market given this change? I think a lot of people would probably answer that question no. So this is a pretty bad scenario. This would be a loss of 20%, 21%. This is what the REIT markets were telling us about the effect of the pandemic, is that real estate was losing 20% of its value. And that is also why I think it's a bit of an exaggeration. So I'll just take you through a couple more slides about why I think it's a bit of an exaggeration. This is office vacancy. Los Angeles is orange, Orange County is blue. Sorry, I should have made it orange. San Diego is green and Inland Empire is yellow. You can see the effect of the pandemic kind of on the right side of this chart. You can see how office vacancies, look in LA County, they went from 10% to 10.3. In Orange County, from 9.7% to 10, 9.2 to 9.7 in San Diego, and barely up in Inland Empire. That is not some huge issue. Now, there are fixed term leases here. So just because there's not a vacancy doesn't mean that there are people in the building working. The people are not in the building working, but the tenant hasn't decided to break their lease, right? Office rent per square foot. You can see minor declines here. Again, office sales volume went down quite a bit. You can see the sales volumes dropping, especially in LA, which is the largest office market, which just means that people couldn't meet. There couldn't be a meeting of the minds during the pandemic because the seller was saying, hey, I've got a PPP loan. I'm not highly leveraged. I'm not going to sell during a crisis. And the buyer was saying, well, I'm only looking for heavily discounted distressed assets. And those two people just couldn't meet up. There weren't enough of them that kind of could meet each other. Industrial vacancy, yeah, again, not really major differences. Industrial rent actually is still kind of going up. Industrial sales volume, you can see, fell quite a bit, but again, this is somewhat temporary. Like when industrial sales volume falls, it means theoretically values are falling, but because the market's not efficient and there aren't transactions happening, you're just kind of in like a limbo. Over the 10-year scale in industrial sales volume, you can see we're still on the long-term trend. It's not like it fell off a long-term cliff. It fell off kind of some of the growth that it's had since maybe we're back to like your 2016 levels. Retail, same kind of thing. You see a bump in vacancy, you see a little drop in rents, you see a huge drop in sales volumes. On the 10-year scale, you can see that retail is hitting a drop. But look how much LA retail had been booming, right? So it's just relative to where you're coming from. Apartments, you can see the drop in vacancy actually coming down in Empire and coming up in LA. This is why I say people are moving from LA to the Inland Empire, because you can see it right here. It's almost exactly corresponding at Q1 2020. The LA vacancies go up, and Inland Empire vacancies go down. So people not wanting to pay those high rents to be in smaller apartments near an office building they're not even going to. Multifamily rents per unit, again, you see more growth in Inland Empire than in LA. Sales volumes, you see them drop in LA, but not a ton in these other areas. And on the 10-year, you see the drop in context and longer context. So kind of my thoughts and predictions are that your urban base industries for Southern California, which would be media, tourism, and international trade, and the support industries around those, so restaurants in downtown LA, shopping in Beverly Hills, those are the things that are going to suffer most. And we kind of see that in the LA trends. The suburbs are going to suffer less because this kind of, this pandemic has accelerated something that everybody was saying is taking a long time. And that was millennials getting married and having kids. It wasn't happening because millennials hadn't saved up enough money, housing wasn't affordable, lifestyle choices were a little different, right? But now, when it's a choice between living with parents who are at high risk for a virus and going to buy a house or have that child when we're spending 6 months together with nothing else to do, like you see that those things are now starting to happen. Family formation is happening. And despite what everybody had said about nobody wants to live in the suburbs anymore, when you have kids and you want a dog and you don't want people thumping up above you and you want to have your own backyard, like suburban life is kind of still where it's at that stage. So you see also remote work. As remote work becomes more popular, it's like, hey, you know what? Would I like to be in an urban area in a small apartment and go to the office? Or if I can be allowed to work remotely, wouldn't it be better for me to be in a bigger place, not commute at all, and be near my loved ones? So you're seeing that. Third point, commercial real estate has been floated by a lot of government stimulus, a lot more than they provided in the Great Recession. So I think the stimulus somewhere around $3.5 trillion right now, and GDP of the entire United States per quarter is somewhere around 5 trillion, 5.3 or so. So they almost floated an entire quarter of GDP, which is, I mean, it's huge. So that has allowed, that's why sellers aren't selling real estate, is because they don't have to, is because the government talked to banks and said, don't foreclose, provided a lot of stimulus, provided unemployment bonuses, and because since interest rates dropped, your bond yields are so low, where are you going to go? If real estate is a 5% return and the 10-year treasury is 0.7, where are you going to go to get that return back? I think value decreases are going to be in the 10% range for office and retail, and less than that for retail, for multifamily and industrial. In fact, industrial is not going to decline at all. I think the REIT data were just, like I said, exaggerated. But 10%, you know, losing 10% in a real estate investment is not fun, but it's not just devastating either. I do think that we've built up this debt culture in the United States that is actually the solution to every crisis we seem to face, is like, hey, let me give you low interest loans. On the long term, I think that's pretty unhealthy. On the short term, it seems to have worked a few times because inflation hasn't actually reared its head. If usually in the past, theory was that if you put so much money into the system in low interest debt, you're going to have inflation, and that's going to cause a problem. We haven't seen that happen, and you know, there are theories around that I won't go into. But until inflation actually happens, the debt culture is kind of going to float us through some of these short-term crises. And then finally, I think that interstate rates of growth and return are going to even out more. And what I mean by that is coastal markets in this last recovery were all the rage. Cap rates went down, rates of return went down, prices went up in LA, Orange County, et cetera. A cap rate for, let's say, a Wendy's in LA might be 4.5%. A Wendy's in South Carolina might be 6%, right? I do think that those are going to even out more, because I think there's a migration out of California and an understanding that there's some political risk in California that doesn't exist in some of these other places. So I think you're going to see more investment, and already are seeing, in places like Texas, Idaho, Colorado, Arizona, Nevada, you name it, and less relative investment in California. Although California will still be big, it'll be less big than it was. So that kind of concludes my presentation. And if you guys want to unmute yourselves and kind of kick around some of these ideas or ask any other questions, I'm happy to do that.
I had a question. So, I've had my real estate license for quite a while, but I haven't really gotten into it because it's a hard thing to break into, and it's a hard especially in Southern California, to find clients and things like that. So my dad has an apartment building in LA that he's looking to sell, and so it was going to be my first big sale, and we put it on the market, and then COVID happened. We did it in I want to say February. So he's debating on whether he should like hold on to that for a little while till this passes, or if now is still a good time.
Right. Yeah. So like broadly speaking, not to your dad's situation in particular, but broadly speaking, when we look to make buy sell decisions on assets, we're trying to look at what are we going into next. It's usually not that we just want to sell something because we're tired of it, but more we want to buy something because we see an opportunity, and that, you know, there's something that we already own that we feel like doesn't have that opportunity, so we'll make that trade. We're usually not sellers just because there's so much transaction cost that, you know, when you sell a property, you lose 5% in your commissions, another 1% in your closing costs. You can 1031 exchange, which you absolutely should do to kind of save some of that tax hit. But the next opportunity you're going into has to be a fair amount better to make a sale make sense. And then, you know, LA apartments, yeah, they're going through, I think, they're going through a period right now of a little bit of decline after just a huge run up. So if the idea was, look, we've made a lot of money in this, we don't like the long-term prospects, let's take this off the table and put it into XYZ. Yeah, that's not a bad decision. You know, so long as you have good representation and, you know, you're kind of doing your due diligence through that process, it's not a bad play.
Okay, thank you.
You're welcome. ¿Otras preguntas? You guys are quiet. You guys are eating. Your computer's in the other room. All right, I'll hang out while you get up your courage. And then, Araxi, you can take over anytime if nobody else wants to chat. Can they talk, or did you mute them all?
No, they could talk.
Okay. I want to hear from Connor. Speak it into existence, Connor. What's on your mind? He's out. I want to hear from Isabel.
Hello.
Hi.
I'm here.
All right.
So my question was, if somebody's interested in getting into development, what are the steps that should be taken?
Yeah, great question. I get that a lot. I think of development as like a capstone course. So if you think of it as like, you know, emphases in an undergraduate major, think of like development is that capstone course. So a development team has folks from different disciplines. It usually has somebody who is the finance guru. It usually has somebody who's the construction guru. It usually has somebody who is the market valuation brokerage type of person who can find the deals. It might have somebody with attorney, like legal background, right? So it's really, you know, when you say, how do I get into development? I think there's really, it's a two-step process. The first step is you've got to build your expertise in one of those silos. You've got to be that finance guru, or that construction or acquisition guru, or that legal person, or property management even, although it's perhaps less common. Accounting is somewhat common. So you've got to build that expertise up in that area, and then you got to go find your team. And so that then parlays into something else, which is the USC program, the Masters in Real Estate Development program. I get asked about a lot too, like, hey, how is that program? Should I go into that, et cetera, et cetera? And my answer is always the same as well, and it goes with what we're talking about, is get 5 years of work experience in that silo after your undergrad of what you're going to be good at. And then when you go to USC, what you're going to find out is it's about 50% education, about 50% networking. And so if you go too early and you're like, okay, I don't really have career experience, but I want to learn XYZ, then you've missed 50% of the program, because nobody wants to be on your team because you don't know anything yet. But if you go at the right time, you come out of USC not only with additional education, but with a team. And that one team I know that's gotten huge, I think they were, I think it was like they had 600 or 700 million under management, and they went to school with me. While they were at USC, they met each other. USC had 2 Walgreens drugstores that it wanted to sell. Somehow these guys talked USC into selling them to them at these ridiculously low prices. It's like a crime. And then they flipped those, made a couple $1 million, and then boom, they were off to the races, right? And they just kept doing it. So that would be my recommendation. You can't really come out of an undergraduate program at Cal Poly and say, I'm going to go into development, unless you really already have like a family or friend of family connection and somebody who already just really believes in you. It's pretty hard to just get those positions by sending your resume. All right, Kai. You there, Kai? Tell me what's on your mind. It's not going to do it.
I could ask my question.
All right.
It's more about Prop 15. Like, what kind of changes would you expect?
Yeah, I'll send you a good article on it. You know, the real estate market, the real estate companies are lobbying heavy against it for obvious reasons, right? Like, so the way, just for a little background, the Prop 13, which was enacted in 1978, means that property owners' property tax is limited. Their property can only be reassessed at time of sale, right? So if they've held it for a long, long time, it's not being reassessed. And between reassessments, the tax liability can only increase 2% per year. Well, there are folks that, and you know, you've talked to your parents or uncles or aunts or grandparents, there are folks that came out here and bought real estate in the 1960s in Beverly Hills and Newport Beach, and their tax basis is very, very low. They don't pay a lot of property tax. So what Prop 15 proposes to do is to split the residential from the commercial and say, look, for residential, for your own home, we're going to let this continue. Nothing's going to change. But for commercial, we're going to make these people get reassessed every year and pay up, because essentially we've been subsidizing their tax liability as a state for sometimes 30, 40 years. And they've been making money hand over fist, living the life, and not paying their share of tax. The real estate industry is hugely against it, and there are some fundamental kind of truths to what they're saying, which are, hey, look, if taxes go up, the landlords are just going to pass it through to the small businesses who are occupying those spaces. Prices are going to go up for everyone. Small businesses are going to go out of business just on the heels of this pandemic. It's going to be a huge problem. Landlords, there will be less transactions. It'll be bad for the real estate industry. On and on and on. I personally, this is my editorializing here, I just think, like, look, the state needs money. Education, employment programs, diversity initiatives, these things need money to go. And the money's not coming from nowhere. So the one thing I don't like about Prop 15 is the way the money gets used. It says, well, first, to pay back any government investments in, like, what losses owing to the pandemic, and then to schools. Well, that first is so vaguely defined that I'm afraid that the and then will never come, right? So I kind of support like the idea of a split roll property tax. I don't think commercial investors need the subsidy necessarily. We can deal with it. But I kind of don't support the money going into a black box in Sacramento where they're just going to lose it like they always do.
Got it. Thank you.
Yep.
And we have a couple questions in the chat.
Oh, okay. Let me look at those. Sorry. Oh, where is it? Okay, in the chat. Okay, so let me go through these. Presentation first, so please sign in. Speaker's not working. What I think about real estate wholesaling. In a couple weeks, you're gonna have Tyler or Ted. He does a lot of that. I don't do it. I'm just in the commercial space, and we don't really have wholesaling. That's a residential thing. Question: how did I become an appraiser? So I'll try to keep the personal story brief. But basically, my wife and I were working in downtown LA around the 9/11 attacks. Well, during the 9/11 attacks, we didn't go to work that day because the New York attacks happened early enough that the LA firms said, hey, don't come into work. There's something going on in New York. My wife actually worked in what's called the Library Tower, the US Bank Tower, which is the tallest tower in LA, and it was a target for the attacks. The plan was that they would also get planes coming out of LA, and that one of those would crash in the building where she worked. But because the timing was off, they never got those planes off the ground. All the planes were grounded. So that was 9/11. By October 1st, I was out of downtown LA. Went to work for a real estate appraisal firm in Claremont. I was going to go to law school at that time, but a lawyer that I knew said, hey, my brother's in real estate. I don't think you really want to go to law school. I don't enjoy being a lawyer. Why don't you at least talk to him? So I did. And then I liked it. And then my wife came and worked with me. And then a couple years later, we started our business. So we really found through that, tragic time for the country, we really found, I think, an allure and an opportunity in small business and in real estate, because, it's before that, when you're in downtown LA, everybody's the small fish in the big pond. But, your identity is in like your business card. You're like, hey, I work for Cushman, I work for CB, I work for, Skadden Arps, or, some big firm. And I guess, I don't know how much that ever meant to us, but certainly when we got into small business out here where we're calling our own shots and living with the results, it's just something that's always been more appealing for us. And so we kind of didn't look back. Let's see. Yep, I think those are the questions on the chat.
We're almost to the end. So I don't know if you want to hang back and maybe they have more questions.
Yeah, feel free to ask anything. Otherwise, you have my contact information on the slides. I'll send them to Roxy. Happy to help anyone if you have a question one-on-one, you didn't feel comfortable, asking here, you want to email me or give me a call. We can talk. Yeah. Otherwise, you're in a good program. You're in a good school. I'm telling you right now that firms are looking a lot harder at Cal Poly as a source of kind of what comes next, because resiliency. Like, this pandemic has taught, I think, firms are having a lot of HR problems. I kid you not right now that firms are having a lot of HR problems. You got a lot of folks that when something goes a little wrong, they think not coming to work is the way to solve it. And I don't want to say whether that's good or whether that's bad or whether that's moral or whether that's immoral. I will say this: if you own a business and your employees won't come to work, it's a problem. So Cal Poly is one of those places where a lot of the folks on this call, work is not new to you, right? Like, you grew up working, you know what it means to get up and be somewhere on time, and take the crap that rolls downhill when it rolls downhill, because that's just the way it is. There's folks from UCLA and SC and Harvard and Stanford that don't understand that, and they never will. So this is an opportunity right now for you guys to really get yourselves out there, network, and I think you'll find some good opportunities if you're looking for them.
Thank you, Matt.
Yep.
Thank you.
Welcome.
I'm gonna hang back just if anyone has any questions. You guys could go ahead and ask me anything. They all seem to be leaving.
Yep, there they go.
Yeah.
Quiet as they came.